Financial markets have been in a panic over a sharp economic downturn that is yet to make an appearance, and in fact may never. Many of the world's biggest stock markets, including the UK's and Japan's, are now in bear market territory. That is off by 20% or more from their peak, and the Dow Jones Industrial Average, before last Thursday, was down 9.5% on the year. Yet, if there's no sign of similar stress in the broader economy, why pay attention to financial indexes that, as the old joke goes, have predicted 9 out of the past 5 recessions? There are 3 possible reasons that the recent market sell-off could be cause for concern. The first is that a recession is coming, but is yet to show up in the data. The US seems due, since its economic expansion is now the 4th longest since World War II, and the stock market is typically a leading, albeit error-prone, recession indicator. But hard economic data is not behaving in a pre-recessionary fashion, and while US growth was probably near zero in the last quarter of 2015, employment growth actually accelerated. Consumer sentiment rose in early January, despite anxieties about stocks and housing, which typically leads the economy into a downturn, but has seen an increase in the number of permits issued to build single-family homes in December. But what about the rest of the world? A collapse of growth in China would be a world-changing event, but there is simply no evidence of such a collapse. True, China's growth last year fell to a 25-year low of 6.9%, but that's the rate the government had long targeted, and December imports and export data suggest China is in fact stabilizing. Surveys of purchasing managers from around the world show that overall economic activity slowed a bit in December, but to a level consistent with normal long-term trend growth. And although oil prices have slumped to multi-year lows, that says less about demand, and in fact Chinese consumption actually is still growing, than a flood of supply, particularly from US shale oil producers. The second possibility is that rather than economic weakness triggering financial panic, the panic itself produced a crisis or recession. The collapse in oil prices, for example, has caused yields on corporate bonds issued by both energy and non-energy companies to jump, and many American banks have reported big loan losses to energy companies. On the other hand, US banks have little exposure to energy compared with their exposure to subprime mortgages in 2008 or Latin American debt in 1982, because regulators forced them to thicken their capital and liquidity buffers since the last crisis. The third and most plausible possibility is that markets are losing confidence in policymakers, driven in particular by the events in China and the US. Chinese leaders fumbled in their efforts to stop their stock bubble from deflating, and confused the world when they developed the yen last August and again this month. Chinese monetary policy is opaque and politicized, which means outsiders are skeptical of the official story that the devaluations are part of a move to a more market-determined exchange rate. But while the US Federal Reserve is much more transparent and independent, the problem is that financial markets disagree with its plans. Last December, the Fed announced that with unemployment down to 5%, the economy no longer needed the support of near-zero interest rates and began to raise them, with the intention of lifting the short-term rate to more than 2% by the end of next year. However, the plunge in oil prices has put the Fed's 2% inflation target even further out of reach, which, markets believe, in contrast to the Fed, merits an even slower pace to rate increases.